Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. You worked hard to earn your money and deserve to enjoy your retirement income. And when deriving income from investments, possibly a pension, Social Security, there's a lot of factors that are going to impact your taxes. If you have a taxable, tax-deferred, and tax-free accounts, for example, you have additional flexibility to manage your income. Therefore, when withdrawing from each account, thoughtful planning should be considered as there's no hard and fast rules on which to use first. With taxable accounts, most dividends and fixed income investments, as well as gains from selling securities less than 12 months, will generally be taxed at ordinary income tax rates. But for qualified dividends and gains from the sale of securities held for more than 12 months, those are taxed at capital gains rates, which are lower than ordinary tax rates. During your working years, you had the opportunity to contribute to qualified retirement accounts such as 401k, 403b, IRAs, and you postponed paying the income tax. The money was able to grow tax deferred. However, these are not permanent tax shelters, as you need to pay ordinary income taxes when you begin taking required minimum distributions. But chances are you retired in a lower tax bracket, thus you'll retain more of your nest egg. If you still have company stock held in a 401k, the IRS provides more favorable tax treatment for those shares. So this would be a good reason not to roll it over to an IRA, as you would forego the special tax benefit. If you contributed to tax-free accounts like a Roth IRA, a Roth 401k, or a health savings account, the qualified distributions are tax-free, and they will not impact your Social Security taxes or your Medicare premiums. If you have sizable balances in your retirement accounts, or you believe that Congress will not extend the reduced tax rates that were enacted through the Tax Cuts and Jobs Act, which is due to expire at the end of 2025, then you may benefit from converting some of your tax-deferred accounts using the Roth conversion strategy, and that'll help mitigate higher taxes later in life. During your retirement income years, it may make sense to adjust your portfolio to take advantage of more tax-efficient investments. Municipal bonds are very tax efficient because they do not incur federal taxes, and often the interest income is tax exempt at state and local level. Treasury bonds provide tax efficiency as they are exempt from state and local income taxes. And among stock funds, exchange traded funds tend to be more tax efficient than mutual funds as they have fewer what are called in-fund capital gains events. Depending upon your combined income and tax filing status, up to 85% of your Social Security benefits are federally taxable. Now, when I say combined income, that's the sum of your adjusted gross income, tax-exempt interest, and 50% of your Social Security benefits received. Now, if you experienced a cash windfall a few years ago, like from an inheritance, although you may not have paid taxes on that income, your Medicare premiums will likely go up this year. Sometimes they could double or triple. That's because Medicare premiums are based on your modified adjusted gross income from 2 years prior. If you're age 65 or older, you're eligible for an additional tax deduction when using the standard deduction on your income tax return. The majority of states have an income tax, so there may be advantages to relocating to one of 9 states that have no state income tax to help reduce your retirement income tax burden. Also, some states will tax your pension or annuity benefits, so you will want to consider how that impacts your income situation. If you'd like to learn more or have suggestions for a future topic, please email or call me. Thanks very much for joining.